As we ring in a new year, many of us are now 1 year close to retirement, hopefully, or we're already enjoying retirement. Now, income ETFs, they can be an awesome way to supplement and build wealth because of their consistent dividend payments, which means bills can be paid without having to sell any of your initial investment. And done correctly, when money is spread out, it gets diversified and it gives reliable cash flow every single month. Today, we're going to rank the best income ETFs for 2025 and beyond. So what is the methodology that I use to rank these income ETFs? Well, the criteria that I use is that these ETFs, they need to maintain that NAV. So I'm talking about no dreaded word that we hate to say, NAV erosion. If the NAV just continues to go down every single time they pay dividends, then what is the purpose of this investment? It's okay if the stock isn't constantly going up, but the principal should not be leaving. If I'm just getting returned my own money, I'm not really making any money. And there are plenty of income ETFs that unfortunately do this, and many people are hoodwinked into thinking they are making real money. Number 2, price appreciation. Again, I don't really care too much about the price appreciation because I know it's going to lag the overall market, but I generally like to see it go up a little bit over time. Then we also, of course, look at dividends. I want big dividend payments. Now, some funds are offering well over 100% yields, and many people think this is sustainable. It is definitely not sustainable. I've noticed that really anything over the 12% in dividends every single year is usually not sustainable. Otherwise, there's other red flags that you need to look for. It's probably having a lot of NAV erosion. The dividends are continuing to get smaller over time. That's just not a good recipe for us in retirement. And then, of course, the longer a fund has been out, the more I tend to trust it. So generally, the longer a fund is out, the higher I'll rank them on this list. Though there's been just an explosion of income ETFs in the past year. So a lot of these are still relatively new. And then, of course, we're going to be looking at the performance since the last time I made my income ETF video, power rankings video. So that came out on November 28th. So I'm going to be putting extra emphasis on how these funds have performed since November 28th. For perspective, the S&P 500 or the SPY has actually lost about 1.15% in value since November 28th. But the triple Qs, on the other hand, they have actually went up 2.63%. So SPY, triple Qs, totally different index, totally different companies, totally different weightings. So that's why you're going to see a little bit of a discrepancy in these. And you're going to definitely see these in the income ETFs as well as we go through these. Those that track the S&P 500 or similar to that have a negative return. Those that are more NASDAQ 100 based, those will have a positive return. So let's get straight into it, guys. What stocks just barely missed it? These are the ETFs that just missed out on cracking the top 10. We have T-SPY, which returned negative 3.1%. We have the very popular SVOLV, negative 3.3%. A lot of people were mad that SVOLV dropped out of the top 10 last time. Still think it's a great ETF, but the top 10 is just so competitive. To be in the top 10, you need to be really good at both price appreciation and getting those juicy dividends. Then BITO, this is one that does options trading based on Bitcoin. This was down negative 7.66%. Again, this is going to be that double-edged sword when you play with Bitcoin and volatility like that. When it's going good, you're going to make a lot of money. When it's not going good, you're going to lose a lot of money. Then we have SPY-T returning negative 4.17%. And I was very disappointed in this one. IWMI, Russell 2000, NEOS product here. They unfortunately returned close to negative 7%, which was surprising because a lot of these NEOS products just do so well. So these are the ETFs that just missed it. If you guys know of any other ETFs that are very good that I'm just not paying attention to, let me know in the comments. The more that people comment on a particular ETF, the more higher I tend to rank it, right? There's over 100 different income ETFs out there, right? There's no way I'm going to be able to keep track of all of them. That's why I need you guys to let me know in the comments below. Number 10, QDPL. All right, so we got a new income ETF moving into the top 10 here. This was a one to watch last month, but now it is cracked the top 10. So this is a Pacers ETF, QDPL. In 2024, they were up 19%. Now, they are managed by Pacers ETFs. They aim to provide cash distributions equal to 400% of the S&P 500 while getting about 90% exposure to the S&P 500. So what happens to that other 10%? Well, it goes toward collateral to buy dividends futures. Now, these are basically contracts where you pay a certain amount of money today for a right to receive a dividend future payment in the S&P 500. Essentially, you're paying upfront to lock in future dividend payments. That's kind of how this fund works. It's only going to be yielding around a 4 to 7% dividend target. Again, that's going to be about 4 times what the normal S&P 500 returns. I know that's not the highest yield, but we will be covering ETFs that offer a much higher yield, but we're getting a chance at some really juicy capital appreciation here. It's consistently paid about a 50-cent dividend since their inception in 2021. Now, they do pay quarterly dividends. I know it's going to turn a lot of people off. A lot of people like those monthly dividend payments. Well, actually, a lot of people like those weekly dividend payments, but this one, you'll only be getting 4 checks a year. So it's about 16 to 17 cents a month if you break it into, if you divide by 3 for each month. An expense ratio of 60 basis points, so it's not super cheap. It is going to cost you a little bit. It is actively managed, but we're getting a chance at capital appreciation and some yield. I hope to continue to see QDPL on this list in the future. Number 9, we have QQA by Invesco. This is also the debut of QQA, the Invesco Income Advantage ETF. I just put out an entire video going way more in depth on this fund. It's only been around since July of last year. By last year, I mean 2024. But it has impressed so far. It's up 5% in capital appreciation. And if we annualize their yield, they're going to be ranging around that 8 to 10% mark. So that's pretty good. It's been pretty consistent. They're doing options on the NASDAQ 100. Invesco, of course, runs the very popular Triple Qs ETF. So the NASDAQ 100 is where it gets that income generation. It also offers some downside protection. And of course, it has some upside potential as well. So one really cool thing about Invesco is that they've actually agreed to waive the fees for this fund till June 30th. I know previously it was like December 31st, so it looks like they've extended it for another 6 months, which is pretty awesome. That's more money in our pockets before we start putting more money into theirs, right? This is a way that they're trying to sell to attract new investors into the fund. It's already a pretty cheap expense ratio to begin with, but the fact that they're waiving it is pretty awesome. Number 8, XDTE, QDTE, Roundhill. Now, these are the 0 days till expiration ETFs. They pay weekly dividends, and the dividends have been indeed quite fat. Now, again, really want to emphasize to you guys that getting paid weekly versus monthly makes next to no difference from a cow pounding perspective. I know it feels good to get those dividends weekly. Trust me, I love that dopamine rush of getting dividend payments in your brokerage, but it's really a very poor reason to be picking an ETF or over another. Now, this fund aims to profit from options premiums and overnight movements of the index. These are about to hit a 1-year anniversary, mark their very first birthday. Overall, they've still been pretty impressive. NAV erosion is starting to become more clear though on QDTE, which does have me a little bit concerned. They've had a rough couple weeks since we last talked here, negative 5.12% and negative 5.28%. Number 7, YMAX, Misty, Yield Max. Oh boy, you already know this is gonna be fun. So YMAX, they did have a pretty solid 2024. It's about to hit its first birthday here in a couple weeks. Overall, it's down about 14% in terms of NAV, but it has returned around 44% in dividends. So I'm not going to complain too much. YMAX has been doing pretty solid. But what I really want to talk about is the beloved Misty, the cream of the crop for these high yield dividend warriors. So if you guys remember my last video, I gave them their roses. They were ranked number 2. But as I predicted in that video, This is a ticking time bomb. It is a very high risk, high reward play. It is absolutely not a position that I would ever want to be a core position in my portfolio. Now, part of retirement is being able to sleep very well at night and not have your income streams just dry up all of a sudden. Misty just happened to go up 8% the day prior to me filming this video. So this would have actually went down 21% in just a few weeks had they not had that miracle the other day. Now, can you imagine this in retirement? Your net worth going down 21% in just a few weeks. This is all the money that you worked very hard for your entire life. Imagine that conversation with your wife or your husband.
Hey babe, you might want to take it easy on those margaritas. We just lost a good chunk of our money for no particular reason when the market opened.
Again, do the market fluctuations for MicroStrategy or Bitcoin, are they based on any actual fundamentals of the company changing or big news? No. It is all based on the price of Bitcoin, which goes up and down with no rhyme or reason. And anytime I hear the MicroStrategy CEO Michael Saylor talk, the more and more I am convinced that MSTR will go down as one of the biggest pyramid schemes / Ponzi schemes, whatever you want to call it, of our time. And there will be a lot of greedy, high yield dividend warriors losing money. Of course, the best part about being a YouTuber is duking it out with all the high yield dividend warriors in the comments. While there's no shortage of dumb comments, no. One of the comments that I found quite funny was somebody claimed that Misty would be a great investment forever because the premiums will forever be high because of Bitcoin's volatility. Oh boy, okay, where to begin with this? There's a lot of stupidity to unpack here. Do people understand what the word forever means? I don't think they know what that word means. If the Earth is 4.4 billion years old and humans have only been here for a fraction of that, what really makes you think that Misty, for the rest of eternity, will pay you dividends? There's a chance that Bitcoin might one day cease to exist with the way that technology moves. Nothing in this life is ever guaranteed. Nothing is forever. Definitely not. Now, crypto has had a spike in volatility because of some short-term news and euphoria. That will not continue forever. And it certainly will not be a guarantee forever. Anybody who tells you something along the lines of, oh, this is just going to keep going up forever and pay you money forever is a complete idiot. Just more delusion by the high yield dividend warriors. Seriously, go to the doctor and you need to get tested for HIDS, high yield derangement syndrome. Number 6, FEPI, AIPY, REX shares. All right, what about FEPI and AIPY making a comeback here? They came roaring back. It's been super consistent in their dividends in the last 6 months for FEPI at least. They have been paying exactly $1.08 or $1.09 each of their last 6 dividend payments. The stock might be a little bit flat, but that's okay because when you're returning that big of a dividend, it's okay if the stock price is flat. Now, FEPI doesn't own that many positions. It only owns like 15 of the biggest tech companies like AMD, Tesla, Google, and Broadcom. So anytime those stocks do well, FEPI is also going to do well. Then on the other side of the coin, we have AIPY. This is a fund that primarily focuses on companies that are big players in artificial intelligence. So this is going to own big companies like Palantir, Nvidia, CrowdStrike, ARM, and Broadcom again. So it's also been a very consistent dividend payer. They've always been around that $1.50 mark, which is not too bad at all. Very juicy dividend yield so far, above 30%. Not having much NAV erosion is key here, and AIPY is doing that. And they've also performed a lot better than other ETFs since our last update, down just 1.06% and down just 20 basis points. That's pretty good. Number 5, GPIQ, JP Morgan Chase. All right, so everybody knows about these two very popular income ETFs, the old reliable and JPI and GPIQ. So JPI actually had a pretty disappointing performance. I mean, to be down 4.47%, that's going to drop them in these rankings. They don't exactly track the S&P 500. It's similar to some of the largest weightings and companies in that index, but they were down even more than others. So that was just very disappointing to see here. Their dividend of 39 cents was also 1 penny less than last month. So the more shares you own of a lot of these income ETFs, even just a couple pennies, that will actually start to make a difference. GPIQ was thankfully in the green. However, their dividend was 5 cents less than their most previous month. Overall, I wouldn't be too concerned with either of these. They have proven to be two of the best income ETFs on the market. They have a low expense ratio, they have consistent dividend income, and they've both returned 15% in capital appreciation all time at the time of this recording. Number 4, BALI, BlackRock. All right, so BALI offers exposure to large caps. It gives some chance at capital appreciation, and of course, it gives that high yield. When there's more volatility, the higher those dividend yields will be. Some of their largest holdings include Apple, Microsoft, Nvidia, and Amazon, and it also uses different criteria to pick the stocks that it owns. They also use some buzzwords like all these other income ETFs use, like proprietary data to pick and screen their stocks. Yeah, okay. And then they're selling call options. So their last two dividend payments, they both cracked over the 20-cent mark. So BALI down 2.77% since the last time we made this update video. Still doing very solid. Still one that I would want to own in 2025. Number 3, ISPY, IQQQ, ProShares. So these funds do daily call options and swap agreements, so there's a chance to get some capital appreciation, and they've actually done pretty well all time so far. So ISPY up 11% and 5% all time, which is pretty good. Now ISPY, their most recent dividend of 22 cents was down considerably from their previous month of 30 cents. In fact, there were months when ISPY was paying close to 61 cents a month to nearly 40 cents a month, and it just continues to go down. So that is definitely not a trend that you want to see. This is why sometimes when you have variable dividend payments, it can make planning for expenses in retirement very hard. That's why I love to be diversified, so I'm not just relying on one particular fund. Now, IQQQ, it has also had very inconsistent dividends. It has gone from 81 cents to 32 cents to 10 cents to 34 cents, back to 16 cents for their most recent dividend. I have no idea what's going on with some of these dividend payments, but you can see how this would be very tough to retire on solely since you have no idea on how much dividends to expect. So since the last time this video was put out, ISPY is down 2.21% and IQQQ is up 63 basis points. Overall, still a solid, good income ETF. I'd just like to see more consistent dividend payments. Number 2, SPY, QQQI, NEOS. Now this is one that I've actually personally been adding to my portfolio. I really like a lot of these NEOS products. NEOS dynamic duo of SPY and QQQI. Their assets under management is rapidly growing as more and more people realize this ETF is the real deal. We're getting a yield of about 1% every single month. That's pretty amazing. In the past year, it's up 7%. SPY's dividend every single month has consistently been around that 51-cent mark. When we're talking about QQQI, it's constantly paid out around that 62-cent mark. It is also up 5.59% all time in terms of capital appreciation. These are still brand new ETFs. It's about to hit its first birthday. A lot of these ETFs, the first real challenge to see if these are long-term buys and holds will be when the stock market has an inevitable market downturn that could happen any day now. That's going to be the first true test. But so far, QQQI, it's giving an even higher dividend yield, around 12 to 14% annualized. So these are ones that I'm going to continue to buy and stash, and we'll just see how they continue to play out. Hey guys, before we move into number 1, did you know last year I beat the market by nearly 10%? Get access to all my weekly trades and my full $220,000 plus portfolio that I made in my 20s in the Patreon link below. Number 1, GPIQ GPIX Goldman Sachs. Man, oh man, it is a no-brainer. The best income ETF yet again. How many straight weeks is this where GPIQ GPIX is number 1? This is the hottest income ETF in the market right now. It's the Goldman Sachs products. They have had amazing capital appreciation. GPIX is up 14% in the last year. GPIQ is up 15%. They're very cheap. Expense ratio is not much at all for an actively managed fund. They are giving around that 7 to 10% dividend yield. GPIQ is continuing to pay out 43 cents in dividends every single month. It's actually slowly going up over time, which is also another promising trend to see. GPIX is paying a consistent 35-cent dividend payment. So until another income ETF comes out that pays bigger dividends and has a chance at bigger capital appreciation, Goldman Sachs will remain on top. Let me know what you think of my rankings in the comments below. Again, I read all the comments and I take them into consideration when making these rankings. So if you think I'm missing an income ETF, or if you want to see your favorite income ETFs ranked higher, just let me know in the comments below. Come join other dividend investors who are looking to retire early on the Discord link below. Leave a like for a small-time creator. My videos are also found in podcast form under the Collect Cash podcast name, and I will catch you on the next one.
I'm going to try to apply for a small business loan of $1 million. Okay, that's the capital I need. Now, the capital I need is not to start the business. The capital, I'm going to take that money to invest in high yield dividends.